All right, let's majorly talk about two core things to begin with: profit and cash. What is the difference between these two things in your perspective?
Okay, so basically, profit is what you can earn by the sale of your goods. So that's something
Mm-hmm.
that you earn, but whenever you're selling your products, you're not always selling it with like cash. Like you can also sell it on credit.
Mm-hmm.
So when you let's say like the price of a pen is 20 dirhams, for example, then
Mm-hmm.
and the cost is 15. So the 5 extra dirhams is your profit. But if you sold that in credit, then you won't like you would have earned the profit, but you wouldn't get like your funds, I think, for a certain amount,
Mm-hmm.
like a credit period.
Okay, very good. Yes. All right. So, yeah, you're right. Profit and cash, we need to understand they're two core different terms. Yes, profit is the money that you earn, and it may not be retained in the form of cash. Maybe we sell products on credit and so on. So, we understand that profit is that the difference between your revenue and your cost, right? During a specific period of time. So we understand that profit, it can be an important indicator of how, when we're evaluating the financial strength of the company in terms of the long-term sustainability, and how effective their operations are, and how efficiently they're working, right? However, your cash is measured when you're taking into account the full range of money that is flowing in and out of the business, right? So this could be revenue in the form of sales, through sales, and it can also be, payment to suppliers, or overhead. So your cash is your inflows, outflows, and all that. So a profitable business is likely to have, a successful business will always have, cash in hand, running money. Yes, that money that you have all the time for your regular expenses is called what? Any idea?
Sorry, could you please repeat that? Your voice like just zoomed out for a minute.
Okay, so the money that you need for your day-to-day expenses, what is that called? Any idea?
Working capital.
Yes. Okay, it's called working capital. All right, so it's called working capital. It's the money that you need on your day-to-day expenses. It's considered the lifeblood of the business. And the reason why it's called that is because a profitable business, you might be making profit, but it is likely to go into, towards failure if it does not have sufficient cash. So, for instance, like you gave me that example, right? So we're selling a pen, we're selling bulks of pen, and the cost of production of those pens were $1,000, and I'm selling those pens for $2,000. My profit here is what? $1,000, right? Yes, no, can you hear me? Is my voice lagging? Can you hear me?
Hello. It's like, yeah, it's like grainy. It's really grainy.
Okay, give me a second. I'm switching my Wi-Fi.
Okay.
Is it better now?
Yeah, it's much better now.
Okay, perfect. So I was saying, yeah, I gave you an example of the pens, right? So yes, you are purchasing pen for producing pen for $1,000 and selling it for $2,000. So your profit is $1,000. Now, at that point, when you made that sale, your customer said, okay, I have to give you $2,000, right? Now understand this, okay? It might get a little confusing, so I'm giving you a scenario.
Yeah.
My customer says, has to pay me, he owes me $2,000 because he purchased all these pens from me, right? He says, I will pay you in December, okay? Not December, that's too far. We're in August now, September. Let's say he says, I'll pay you by September 30th, okay? Now, at the same time, when you are buying the raw material from your supplier, which was worth $1,000, you told yourself, so you bought your raw material in July and you told him that you pay him in August. Okay, so you took a month's credit period. So you took it on credit. At this point, why do you think Mr. Ben, who makes pen, is in trouble? He is making profit, right? He's making 1,000 profit. But why is he in trouble right now?
Because he still has to pay his supplier, but since the
Mhm.
customer is paying on credit, he won't get the money until September and he needs to pay the supplier in August. So that leaves him in like a cash flow problem. Because
Exactly.
he's having more outflows than inflows. So he's sending out more money than he has, which may like put him into, I think, a negative net cash flow.
Yeah. And this was just like a very tiny example. Imagine having this problem at a large scale with multiple thousands of customers. And when you don't have money in hand to pay your suppliers, to pay off your bills, to pay off your overheads, you are going to be in trouble. And businesses that do not have money in hand, cash in hand, to pay their suppliers or cover their costs, they are forced. And not just this, even banks. If you owe money to banks, you don't have money to give back, you will be forced to liquidation.
Yeah,
Liquidation is the legal process of losing your company, basically dissolving the company, and then you're in trouble. Are you understanding all the key terms?
yeah,
Okay. So far, working capital, the lifeblood of business, understanding the difference between profit and cash, and why cash is also important as much as profit is. Yeah.
yeah.
Okay. Working capital is, let's talk about it in more detail. Now, working capital is the money that is available for your day-to-day activity. It is often, by the way, also referred to as your net current assets if you were to write it on your statement of financial position. How do you calculate your working capital? The formula is working capital is equals to current asset,
Minus current liabilities, right?
yes, minus current liabilities, which is pretty simple. So, um, okay, I'm gonna give you an example. Okay, I'm gonna make up a question and then you have to calculate the working capital. Okay. Um, all right. So this is the financial info of Bob Ben's pens. This is from the year 2022, and this is 2020. What we have stock, payment to debtors, short-term loan, and creditors. And this will be in £1 million. Stocks are okay, 8.1, 7.2, 2.2, 1, 0.9, 1, 2.4, 4.4, 5.1, 5.9. Okay. Your job is to calculate the working capital for the company for 2022 and 2021. Just do one of them. 2022. Let's just do it for 2022. If you get it
Okay,
wrong, then we'll
these figures are in millions, right? Yeah, okay.
yes, they're millions. You can simply add them without the zeros, to be
Yeah, that's
honest.
all.
Don't have to make it complicated, yeah.
I got negative 0.3.
And negative 0.3, okay. Let's see. Um, let's do it together. Could be correct. First is to identify all the current assets. What are the current assets? Stock
Cash,
are
stock, debt.
assets? Yeah. Yeah. Okay. What about debtors?
Yeah, cash, stock, and debtors are current assets.
Okay. Cash. Okay. And the other two are
Current liability.
liabilities. Okay. So we added these three together and we got
11.2.
uh, and here we got
11.5.
okay 11.2 minus 11.5 is equals to, yes, it's going to be a negative, obviously. Negative 0.3 million. 100% correct. Okay, so you get the idea. Simple.
Yeah.
Okay, so we understand the importance. We understand the importance of having money and cash in hand, having working capital, right? So for a business, working capital, we need to ensure that your, and by the way, if this is the working capital formula, right? At the end of the day, your most liquid asset is cash, and your least liquid asset is stocks. Your debtors can also turn into bad debts, by the way. It's not necessary that
Yeah.
they might return the money and so and so. So that's one thing, right? Um, So yeah, so we were saying that working capital we is described as your lifeblood of the business, and a business will fail if it cannot meet the immediate financial requirements. We understand that your cash is the most liquid asset of the business, and you can set off your debts immediately. Therefore, it is important to manage your working capital very carefully. What are the ways a business can manage their cash flow?
Um,
Uh-huh. Yeah, go on.
I have one. They can delay purchase of assets is one
Okay,
that I remember from when I was studying.
all right. Delay purchase
Oh, they
of
can
assets.
decrease the credit period.
Very good.
Mm,
Also comes with a however.
yeah, however, they may lose like loyal customers who used
Yeah,
to pay for like yeah. I can't think of
absolutely.
anything else.
Mm. They can also try to increase their try to improve relationship with their suppliers to get longer
Yeah.
credit period. So try to get longer credit period from suppliers, or delay payments to suppliers,
But
which
then that's
also comes with
gonna, yeah, strain their relationship with the suppliers.
exactly. Yes, absolutely, yes. So they can do that. They can also try and take a short-term borrowing.
Yeah. They can take a short-term loan, but there's also a but.
Yeah, I mean they can take an overdraft, but of
Yeah,
course comes with an interest rate.
yeah, and exactly, that's just gonna be more expensive to them because in overdraft, the interest rates are still relatively high.
Exactly, yes. So there we go. One, so if we have too little cash flow, too less money, and then these are the ways to manage it. A business, however, can have too much working capital in hand as well. So if the business is holding a large amount of cash, it's likely to miss out on opportunities. And that would lead to, having a major opportunity cost. You could simply just use that money for expansion, for growth, for long-term investments, because it's like basically free money, isn't it? You're not paying any interest. It's your own money. Why not put it in a better place? You can even put it in the bank and get some interest in return if the interest rate is high, especially. So these are your ways of managing cash flow. Got it?
Hello?
Yes. Can you hear me?
Yeah, yeah, now I can.
Yeah. Okay. So let's talk about the liquidity position. That's another part of this chapter. Okay, the liquidity position. So your statement of final position, it consists of your major financial information that is required to basically decide if the business is in a liquid position or not. So what does liquidity mean?
Um, like basically like the amount the amount of cash you have available in the business. I
Okay,
guess.
or you could
Or
say the
like the
mhm,
amount of like assets or current assets you have that are liquid or like that can easily be converted into cash.
absolutely, so that you can pay off your debts, right? So liquidity simply means the ability to of a business to pay off its short-term commitments, financial commitments, right?
Yeah.
Pay off its short-term debts. So so a business, that cannot pay its bills is likely to face a lot of problems, like their basic needs they cannot fulfill, or that they won't be able to pay off their short-term debts off, be it bills, be it paying suppliers, be it trying to get raw material, anything, right? So, you will need money to pay off these loans and all that, or your make regular payments for the regular survival, right? So this is one part of our chapter done. Let's move on to cash flow forecasts. Okay, what is the difference between a cash flow and a cash flow forecast? Or is there no difference between the two? That could also be possible.
Between what, sorry?
Cash flow and a cash flow forecast.
Okay, cash flow is basically like the amount of money that goes in and out of the business, like that flows in and out of the business. And a cash
Mm-hmm.
flow forecast shows the amounts and the different purposes for which the money is flowing in and out. And it also shows like the opening balance at the beginning of each month, the net cash flow, which is basically like the inflows minus the outflows, and the closing balance. So this is basically the forecast where the finance department of a business looks to make sure that they're not in any debt and to make sure that their net cash flow is positive, or more importantly, like increasing.
Okay. Both cash flow and cash flow forecast, both of them show the ins and outs of the business and the overall financial position and everything. The only difference between a cash flow and a cash flow forecast is that a forecast is a future prediction. The document is exactly the same.
Oh yeah, I completely forgot what forecast meant. Sorry.
Yes, that's why it was a trick question.
Yeah,
So
I right
cash
into
flow
it.
forecast is a yeah, it's a future prediction, and cash flow forecast, literally the same thing, the format and everything. But cash flow may be current. A forecast is a future prediction. It may or may not be correct, or it may be influenced by the external influences and so on. Okay, so a so we could simply say a definition for a cash flow forecast is that it is a prediction of your anticipated inflows and outflows. Okay. A business plan, when you make a business plan, a cash flow forecast is a very, very important part of document of that. Okay. So key terminology for your cash flow: inflows. Wait, inflows, outflows is the money coming in and out, right? That's basic stuff. But a net cash flow, the opening balance, the closing balance, are the core definitions we need to know. Your net cash flow is basically your outflows minus your inflows, right? And your opening balance is the money that you have at the start of the opening period. It usually is your closing balance from the previous month. Does that make sense?
Yeah.
So if in Feb my closing balance was $2,000, £2,000, and Feb March, my opening balance will automatically be, I'm already starting the month with the previously saved £2,000 from the previous month, right? That's why it's my closing balance for the last month. It's the money I'm starting my month with or my time period with. The closing balance is the money that you have at the end of the month or the end of the period. So you can get this by adding your net cash flow to your opening balance. How much money came into the business, how much money you made, and how much money you started with, right? So that's your closing balance. Make sense?
Yeah.
Okay. Um, does your does HL require your calculations? It does, right? Calculating
Yeah.
these. Yeah. Okay. I'm gonna after going over the theory, I'll find a question and then we can practice that.
Okay.
Okay. So I'm just gonna get done with the theory first. Alrighty. So evaluating what are the advantages of a cash flow? What do you say?
It allows you to plan ahead in case you have a cash flow problem.
Okay, very good. So allows the business to be prepared and plan ahead. Um, Plan ahead to avoid mistakes or shortage of money. Maybe you are predicted to have a very low cash inflow in the month of summers because you're an ice cream company and there's not going to be much demand for your ice cream. So for those time periods, maybe you'll plan an external source of finance, maybe a short-term loan to pay off your money or so and so. So you will have things planned out just so that you don't fall into liquidation and so on. Okay. Right. What else?
Um, I'm not sure actually.
Okay. Don't you think it can help you get a bank loan because it's part of your
Yeah,
business plan?
yeah,
So it can prove to the to the bank and all that or other investors that your company is worth investing in. So it can help attract or convince investors. Okay. It can help the business identify shortfalls or not just shortfalls, even surplus. Maybe you will have more money in a particular time period, and based on that, you can make strategic decisions, for future growth and so and so. Make sense?
yeah,
Disadvantages. The two typical ones. Number one, it's an estimation, may not be accurate, and the business may be too blindsided and they might be too focused on the forecast rather than focusing on the actual thing. Or even if your forecast inflows are way higher planned and you end up getting low inflows, that can be demotivating for the manager, then they might get in trouble, right? That could be one thing. um and it does not take into consideration the external factors. So your external factors can influence your inflows or your outflows. How? Let's talk about that. Um, Inflows, maybe your sales will drop. Sales can fluctuate based on the economic cycle. Maybe there's a recession and the demand goes low. Maybe there is competition. Maybe there's a exchange financial rate fluctuation and so and so. Same goes for outflows. Maybe there's inflation and that leads to higher cost of production because of the suppliers, right? Any external factor can influence your financial forecast, and it will make everything untrue in the end, right? Then we have number three, which is what else? You require what it's time consuming. It's It requires a lot of expertise and highly skilled people to carry out this task. So it can also be expensive, right? So these are your major advantages and disadvantages of cash flow. Yes?
yeah,
Okay, do you want me to pause? So you want to jot this down and everything?
yeah. But I think my laptop's like on a low battery.
Okay. I'll send the notes and then you can note them down later.
Yeah, okay.
Yeah, okay. Then we have, let me see. Okay, so this is, okay, yes, one more. How can a business improve their cash flow? All right. Improving your cash flow, that could be, have we talked about this already?
Yeah, kind
Yes,
of.
way to manage your cash flow. There's actually more. I want to go over them as well because I just checked the book and there's a lot more there. Okay.
Okay.
So we did say reduce credit period. Done with that. So we got that. Make use of an overdraft. Delay payments to suppliers. Okay, there's one that says sell assets that might not be needed or lease them back. So if you need money, sell the useful assets and then lease them back. Take them on a lease, right? So what happens is that you might sell your asset and get a massive financial cash injection. And for that, in the end, you'll still have the machinery or the asset because you've taken it on a lease, right? And you're just paying a small amount of lease payment for that. But you still got like a massive cash injection at that point that you really needed the money. Then we have sell off your stock. If you're a public limited company, sell shares. That also comes with a however. However, loss of ownership and control, right?
Yes.
And what else could we say? Try to get new investors, maybe partners, new investors. Um, partner, increase your partnership, maybe move to partnership. If you are a sole trader, um, you can change your legal structure, become a partnership. If you're already a partnership, become a limited company, sell shares, so and so. So these are all your ways of improving your cash flow. Okay, cool.
Yeah.
All right. So this is all that I have over here. I think we've got this covered. This topic is covered. Do you want to see if I missed anything out? Um,
I think we've got it all.
yeah, we've done it all. Um, major let's talk about different businesses and how they might or may not face financial problems, cash flow problems. So let's talk about a business startup. Now, a business startup, what is their cash flow going to look like?
Negative in the initial stages.
Mm-hmm. Absolutely, yes. So a business startup, they might have a negative cash flow to begin with, and they might even struggle in getting a financial loan from the investors because nobody trusts startup with money, right? They're too scared they're gonna fail. Meanwhile, a established business, they might find themselves in a better position as compared.
Yeah.
Yeah, they'll find themselves in a much more better position. However, they might still be looking for some growth. Maybe their objectives are growth and they might require some investment uh, for day-to-day expenses to grow, to achieve their objectives, and so on. So, meanwhile, large businesses, okay,